How are you?
Hi, Andy. How are you? It's great to have you here. What are the most important changes that you expect in the period of post-COVID-19?
So we're clearly in an unprecedented and challenging public health and economic environment throughout the world today. There are a number of areas that are due to the pandemic and the economic lockdown in terms of the investment industry, and some other changes that are more generic to a crisis. With respect to a crisis, I think this pandemic called obviously into action the business continuity plans that every institution has. Some of those plans came to work well, and some of them didn't. So this is really now a call to action to many institutions throughout the world to always be ready and prepared. This economic environment that we're living in has exacerbated many of the variables that we had been living before, which was a very high level of indebtedness in the world, and extremely low interest rates, and in some cases, negative interest rates. So because of the action by monetary authorities, the levels of interest rates have declined dramatically, particularly in certain countries like the United States. And the level of deficit spending has increased, quite substantially. So what has happened now in terms of investing is that you have a period of even lower discount rates in your assets for a prolonged period of time. Therefore, the question becomes what is the multiple that you're going to apply to valuations of risk assets, around the world? There is a lot of concern about the levels of valuations of the equity markets. And I will postulate that one of the reasons, for that is because multiples have expanded because the discount rates has come down quite dramatically. Or the risk-free rate has come down quite dramatically. So that's something that has changed, and therefore your asset allocation has to take that into account. Secondly, this crisis has obviously exacerbated the need for very prudent risk management to be integrated completely into your investment processes. And there are a number of institutions that indicate that they do, but in fact, they are not operating integrated. They are operating in silos. The performance part of the business is on one hand, and the risk management part is on the other hand. This crisis has also highlighted the need to understand the factors that drive the performance of markets. Before the pandemic, a lot of the equity securities around the world were being driven by growth and momentum, and quality as two big factors were driving equity performance. There is a tug of war going on right now in the world between the securities that exhibit those factors and the securities that exhibit cyclical, defensive, or value factors. And that is obviously because what has carried the performance of many markets around the world has been those high growth, in some cases, technology companies. But as the lockdown eases and many economies begin to come back to normal economic activity, it is believed that cyclicals and defensives will actually rise significantly. But there is, every day that goes by, there is a little bit of a tug of war between those two areas. Lastly, one major important difference in this crisis has been the resurgence and validation of sustainable investing. for ESG investing. When you look around the world and you look at portfolios that have a great deal of ESG screens, you will see outperformance throughout those portfolios relative to the ones that don't. So we knew that ESG investing was good and was something that would benefit portfolios. But I think this crisis has demonstrated strongly its validity, and I believe that this is now a catalyst for significant growth in sustainable investing throughout the world.
You mentioned the difference with respect to high multiple and low discount rate contributing to a rather bullish stock market movement lately. Do you think it's sustainable, or?
Yeah, I think what is happening is there is no question that the markets are pricey. There are at the higher end of valuation, around the world. I would like to add, though, that when you go underneath the performance of those markets, you will see that performance is carried by a handful of a couple of dozens of stocks that are high growth and high momentum. So when you break down the performance of those indices into, let's say, an equal weighted index, you will see significant differences, especially in the US market. But having said that, the markets are pricey. Now, I would argue that the valuation that the markets have some relevant measures on what's happening in the world today. Number one is what I mentioned today, which is every investment is relative to the alternative. And the alternative right now is pretty nasty, that to have to invest in extremely low yield bonds or to set your money in cash and obviously depreciate because of some rate of inflation. The second factor is that there is a huge amount of fiscal stimulus that is going on around the world. And I think markets have been buoyed by that fiscal stimulus from Japan to the UK to Germany. Even Germany, is providing a significant amount of fiscal stimulus to the US and Canada and many, many other regions around the world and countries around the world. So, so that fiscal stimulus is going to have an effect at some point on economic activity, and it's going to have an effect on asset prices. The third point that probably brings it all together is, as we know, the markets are discounting machines over, say, 9 to 12 month period. And there is a belief around certain corners of the market that this financial crisis is different. It's not the result of a normal business cycle slowing down in which the market gets tired, economic agents don't want to invest anymore, they don't want to consume anymore. This financial crisis and this economic period is induced with a sudden stop by governments to protect people from the pandemic. But the underlying economic spirits are still there. If you look at places that have opened up, especially in the United States, you will see that consumption has increased significantly in a lot of those places because there is a sense of buoyancy and a sense of living and expectations about better economic times later. So it is a real interesting period. It is a bizarre period to some extent, but we believe that sudden stop, once the pandemic is a little bit under control, or we learn to live with it, is going to lead to a recovery that is faster than a normal, a recession. and therefore the market is anticipating that. The market is discounting that through a shorter period of time.
As you said, there's on the one hand a sense of buoyance. That's good. But at the same time, on the other hand, there are some concerns about global governance and the way international order is being hampered by the coronavirus pandemic. I'm referring to G2 tension, if you like. US-China tension has been escalated lately. Are you concerned about it? And how do you see this this challenge will proceed?
Yeah, right now we are living in a world of an established superpower in the world and an emerging one in the case of China. And in periods like this, there is always friction until at some point there is some level of acceptance and accommodation about the role of each superpower. I think that conditions will probably become a bit worse, than they are today. I personally do not believe that we will get to a new Cold War, at least not in the sense of the U.S. versus Soviet, Cold War. That was basically a bifurcation of the world completely, from the NATO countries to the Warsaw Pact countries, and there was very, very little interchange between them, very little transactions, very little trade, almost non-existent capital flows, and the like. I think over time, what will happen is that this competition between these two countries will be in the midst of continued trade, continued financial linkages, continued interactions with one another, but clearly a number of frictions along the way that are going to affect that relationship. So that I think is not perfect, is not desirable, but it is probably the outcome of this geopolitical tension. I think what worries me the most, actually, is whether these two countries engage in a financial war or a capital war. A trade war, I think, disrupts the trade balance, disrupts the supply chains and all of that. But those end up finding their own ways, finding their own alternatives. A capital war or a financial war, it could be very devastating, because the interchange of capital or savings between countries in the world is enormous, multiples of what it is in the exchange of trade or goods and services. And if we were to choke off those financial linkages by these two countries, other countries will follow, other countries will emulate them and put in their own restrictions on the free flow of capital, around the world. And that could definitely have devastating consequences for the world. We're beginning to see some actions like that, from the U.S., some actions like that, from China, not yet to a place in which they reach, significance. But I hope that a better sense prevails that is not a place to go. That would be very, very, devastating for the world economy.
You made a very important point toward the end of your intervention. And relating to that is Hong Kong issue. Now, as we all know, Hong Kong has been a very vibrant, effective financial hub for a long time. now there is increasing concern about how the Hong Kong will shape up down the road. What is your sense about this? Is this something to be, transitory, or rather than permanent change on the shape of international financial centers? Or is this something to be replaced by Singapore or somewhere else, or even Shanghai, Shenzhen? What is your take on this issue?
Well, I myself have been traveling to Asia, and especially Hong Kong, over 40 years, since 1979. And there have been many times in which people have written or have forecast the death of Hong Kong or the decline of Hong Kong. And every one of those times, Hong Kong has come back more resilient, even stronger. In this particular situation today, I believe that Hong Kong will continue to be a major international financial center. Actually, it could have the opportunity to be even larger, maybe much larger than it is today. Now, it will be different. It'll be different, in some respects, but let me address that. Both sides need Hong Kong. The West needs Hong Kong as a gateway into China. Because of everything that is happening, China is not going to stop growing. The financial markets of China will continue to thrive and develop. China will need foreign capital, even more so if there is more geopolitical tensions, because the financial flows going into the capital markets need to make up for the foreign direct investment that has gone into China. And therefore, Hong Kong is the gateway to a lot of that, because many Western institutions are more comfortable going to China through Hong Kong than going direct onshore, going direct into the mainland. So the Western institutions need Hong Kong. China needs Hong Kong more than ever, because China needs to accelerate its opening up, needs to accelerate its lure of foreign capital. And the best way to achieve that is Hong Kong. And now that they feel that Hong Kong is more in their control, whether it's right or wrong, they are going to take a number of steps to increase the viability and the profile of Hong Kong as a financial center. So to take a very bullish view, you could imagine that Hong Kong is or does become the financial center of China, rather than Shanghai or Shenzhen or any other places. I'm not saying that that will happen, but what I'm saying is that on the trajectory of a place like China becoming a big financial center in the world, Hong Kong will need to fill in that void, for China and for the rest of the world. It's unfortunate that obviously Hong Kong will be less free politically and socially. Nobody will like that to happen at this point. I hope that better heads prevail in the way they apply this national security law. But as it relates to the financial markets, there will always be a significant element of rule of law, of proper governance through the Securities Commission and the central bank, proper and efficient capital trading, in the exchange and the settlement system and all of that. And therefore, everyone will benefit from that.
I'm very much encouraged by your observation. Myself also have been traveling to Hong Kong for the last 3-4 decades myself. That I hope to see Hong Kong continue to thrive down the road. Okay. Let me move on to more specific investment-related issues that you are very much comfortable with. First of all, these days, active versus passive is a topic for debate. Now, as you have built MSCI, the largest index provider in the world, what is your take on this issue?
Yeah, so as at MSCI, even though we're well known for our indices for passive investing or index investing, we're also well known for our benchmarks for active managers. If anything, about 2/3 of our client base at MSCI are active managers.
Now, on the trend of artificial intelligence-driven robo-advisor, I would like to have your perspective on this. Do you think we'll see machines replacing humans for investing anytime soon?
Definitely. But I would not call it machine replacing humans altogether. I would describe it much more machines helping humans run the investment process. And to be provocative, there are parts of the index investing style that are, machines doing the work for humans. First of all, a model in the form of an index is the form of a machine, right? The optimization process that some index fund managers do, it's another form of machine selecting the stocks. The execution, the program trading execution of a lot of that is that. So definitely, and what we see is that John, the innovations almost in every field of the world always start at the bottom. They start with the smaller things, the parts of the market that are not as desirable, and they make their way up to the top. So advising started at with individuals that have $3,000, $5,000 to invest. So most people will say, how could robo-advising ever replace humans doing asset allocation in a $100 billion institution? Well, the technology is not different. It's just a question of the development and the nurturing of that technology to be able to get to the point in which you can perform asset allocation in an effective manner and reallocate assets in an effective manner based on certain targets. So, at MSCI, we are always very advanced in the use of new technologies, AI, machine learning, natural language processing, to use it in the way we gather data, the way we identify trends in the data. So, for example, in our ESG investing, we capture massive amounts of data, both from companies that report directly and from third-party sources that follow companies, whether that's a court of law or an environmental agency or the like. So therefore, if we did not have forms of artificial intelligence helping us with that, we will need thousands of analysts going through that data, as opposed to hundreds of them at the moment. So definitely, this is we're not different than any other industry in which artificial intelligence and all the newer technologies are going to help us do our job better.
Okay, great. Thank you. Do you have any sort of last message that you would like to share with Korean audience here, investment community, financial industry representatives in Korea? Anything you'd like to add?
Yeah, I would like to say that despite this horrible pandemic that has cost precious lives throughout the world, infected so many people, inflicted so much economic pain in the world, and particularly those people that lose their employment. in a crisis like this, there's always big challenges, but it's also significant opportunities that emerge. And we're not different than what is happening to our generations of humans throughout millennia, in which we need to embrace change, adapt, transform ourselves, and the like. I think that this crisis, even though not welcome, even though not liked, obviously, by any one of us, will come out of it very resilient, much stronger. There will be a lot of different innovations that will come out of this. And many of them will be in financial services, and quite a lot of them will be in the investment industry. And we need to remain, even in the face of this terrible situation, we need to remain optimistic, positive, and look at what is it that we can do as the current generation of leaders in the world that are in charge of the governance, let's say, of this planet. What is it that we individually can do, and what our institutions can do to further the progress in our respective fields? Or said it differently, it will be a tragedy for this pandemic to have happened. And with that, all those people who lost their lives, those people who have been suffering, and for us to come out of this, the same world that we were before. It will not be a tribute to those people that unfortunately lost their life. We owe it to them to remain constructive and optimistic and bring the best that we can see coming out of this crisis.
Okay, thank you very much. That was a great message in this turbulent time. Thank you, Henry, very much for sharing with us your great insight. I very much look forward to seeing you in person very soon, later this year at the latest. And I wish you all the best.
Thank you very much, and thanks for having me.
Okay, thank you. Bye.